Hey everyone, welcome back. It's Michael from Richucation, and we are here on day 4 of our investing mini-series. Today is the day we're going to delve into supercharging your returns. If you remember from a few days ago, we went through the rule of 72 and looked at how the difference between 8% return and 12% return, that 4% difference, added up massively. So just to refresh for you, the concept is that based on the rule of 72, if you have 8% rate of return, then approximately every 9 years your money is going to double in value, versus if you have 12% rate of return, then it's approximately every 6 years that your money is going to double in value. So what that means is that if we take it out 18 years, $100,000 based on 8% is going to double twice, right? 9 plus 9. So we're going to have $400,000. But by contrast, at 12% rate of return, we're going to have $800,000. That's literally, you have twice the amount of money after 16 years based on a $100,000 investment, only based on a 4% additional rate of return. It's pretty incredible, right? It's fantastic. So we talked in the last video about how one of the big things we can do to increase our rate of return relative to everyone else, because what we want to do is we want to compare ourselves to what's the market doing, because you could buy the market and get that with virtually no effort, etc., right? That's not a problem. Anyone can do that. And we talked about doing some things to help mitigate some of the things that hold other people back. So those things in particular are fees and taxes. And then the other thing that people have is they have loss. So if we're protecting ourselves from those three things, we're already ahead of the majority of people out there. We might not be ahead of the market. That's another conversation. We're going to talk about that in a minute. But you're ahead of your peers. So if you go to all the people around you, just through those three little things, you're going to get ahead. Frequently 2 to 4%. If you can minimize your fees, that can save you about 2% a year, which is astronomical. It's huge. If you can go and minimize your taxes, again, you can get something similar. And we're going to talk about taxes in the next video, and specifically what you need to be doing with respect to taxes in order to most efficiently structure yourself. You ready? You excited? I hope so. All right. Today, there's a lot you can do to increase your rate of return. Okay, there's a lot of technicalities, a lot of nuances. The best people in the world, okay, on relatively kind of like medium amounts of money, because what you're going to find is it's easier to grow a small amount of money than a very large amount of money. Warren Buffett will talk about this. Okay, so what he says is, he says if he had $10 million, he could guarantee you he could get a 50% rate of return. All right, 50% rate of return would be insane. During his early period when he was managing money, he averaged over a long period of time about 30% of his 29 point something percent. And then it dropped down a little bit, and today it's better than most people, but not astronomically great compared to the market. So what we would say is kind of the really great people do around 30% rate of return over a long period of time. What you do in a given year doesn't matter, okay? Because as we discussed last time, you could go up 100% and then down 50%, and you're back at zero, right? What matters is that consistency. And so what does it take to get a 30% rate of return consistently? It takes quite a bit. And you're not likely to get that kind of rate of return on a consistent basis without having some very deep understanding of strategies. And 50% is mind-boggling. I actually did a study specifically on how Buffett could do that based on looking at a whole variety of factors, because, like I said, it's very, very high returns. Okay. But what we are going to talk about today is this fundamental principle that's at the basis of everything Buffett does. Buffett will say that he's 90% Ben Graham and 10% Phil Fisher. Ben Graham is the founder of what's called value investing. And we're going to talk about the very basics of value investing today. You can go and buy our courses and sign up and participate in the action class, etc., for very detailed information on how to invest more effectively using value investment. What we're going to do is we're just going to give you enough to give you a bit of an edge here today. And that's all we're looking for. We're just looking for that few percent edge, knowing that that's going to compound, right, over time. Now, if you can get a much bigger edge, let's say that you went from that 12% to 18%, well, now you're talking about going from $800,000 to $1.6 million in that same period of time, which is, again, pretty astronomical. So anyway, the point is we're going to get into this. this concept of value investing, and it's the number one thing that you can do to boost your returns with relatively little effort very safely. Okay, and that's the thing that I want to really emphasize is risk. You don't want to take on a whole bunch of extra risk. Now, the interesting thing about Buffett is Buffett actually increased return while decreasing risk, especially if we're talking about risk in terms of the probability of loss and the severity of loss, which is the definition that I and people like Howard Marks tend to apply. Okay. In order to understand this, we're going to talk about investing like shopping, and specifically shopping for groceries. Okay, but also gasoline. We'll use those two as examples just to give you a great idea of how things work. And we're going to talk a little bit about how the market flows and go from there. So we've talked previously that the market does not move linearly, right? It doesn't just go up at 8% a year or whatever the number is. What actually happens is it actually goes, something like this, right? Now, here's the important thing. This is also what happens to the price of gasoline, and also what happens to the price of, some sort of, let's say, chips when you go to the grocery store, right? But any type of food. Over the long term, do those prices go up? Yes, they do, of course, right? How do we know that they go up? Well, because of inflation, right? In any short period of time, is it possible that they'll be down? Yeah, as I'm recording this, the price of oil is way down. The price of gasoline at pumps is a lot lower than it's been. Say it peaked out, I think, the summer of 2007 or 2008. But the point is that over time, you have this upward trend, okay? And the reason for that is basically inflation. There's a few other factors, we can discuss those, but just for inflationary reasons, we know that things are going to go up. Now, keep in mind, we're talking about buying productive assets. So you remember when we talked before about businesses that are durable, general funds, or real estate. Okay, those are our kind of area that we're taking a look at. Versus, we're not talking about unstable businesses, we're not talking about startups, we're not talking about things that aren't profitable. We have those rules, okay? Now, imagine you're going to the store once a week to go buy groceries. This is probably pretty typical, right? You're looking at apples or chips or beef or whatever it is you're looking at. And what happens there? Well, they put those things on sale every now and then, okay? And just to backtrack for a slight second, how can you beat the market, okay? Meaning the market's going to do what it's going to do. How is it that you are going to do better than the market? Okay, so if we average out what it's doing, what are the ways? Well, one of the ways, first of all, the more diversified we are, the closer to the market we'll be, because the market is literally an aggregate of everything, right? So we need to be a little more concentrated. We need to say, oh, we're not going to put money here and we're not going to put money here. We're just going to put money in this narrow bandwidth here, okay? Number two, those things, so we kind of have, we could pick different things in the market, okay? We could pick different timing than the market, okay? Those are basically our two ways. And so normally here you'd hold, and remember we were talking about dollar cost averaging and you're just buying all the time, right? Well, what people will inevitably say is, hey, what if I sold right here and bought right here and then sold right here and bought right here, and you're going to get the ups but not the downs, and that's going to work out better, right? Here's the problem with that. It's very, very tough to do. To know, hey, it's up here and now it's going to fall. It's easy to see in hindsight, but very, very challenging. Now, there are some technical traders who are pretty good at it, but that's a job, that's not the freedom that we're talking about investing, and it's very, very challenging. Okay, so for our purposes, just know that you're basically not going to do it. People might say, oh yeah, Fibonacci's and support and resistance and Bollinger Bands and anyway, all these different technical indicators, candlestick patterns and trading on news and all this. You're not going to worry about any of that stuff. That stuff is too complex, too uncertain. It's not the game that we're playing, okay? Some people play it effectively, but most people who play it lose, all right? We want predictability, we want consistency, we want results that you can count on, all right? Now, so I'm going to give you the analogy of sales, say with gasoline, okay? Now, when you go to buy gas, you can look at it, you see the price every day, right? Therefore, you have a good idea of what the price normally is at, or normally within a time period. Now, if the price goes down, imagine it's dropped here, do you know that it's at the bottom? No. Now, it's very, very hard to know, right? Most of the people are like, I don't know, is gas going to go up? Is it going to go down? I'm in Canada right now, and I was just talking to somebody about how it went from 57 cents to 77 cents, back to 56 cents, back up to 83 cents, then 91 cents, now it's 88 cents. Like, it's just all over the place, right? And I have no idea how that works. Like, is it going to go up more? Is it going to go down more? I don't know. Okay. And so when you're there, you're just looking and you're like, is this the bottom? Is this, when it was at 77, down from 102, was that the bottom? I don't know. It turned out it went down to 56. When it goes up to 91, is that the top? Should we wait? Is it going to go down? We don't know. So knowing whether we're at the top or the bottom is very challenging to do. It's not a game that you want to try and play. Okay, so forget about that. Never think, I think it's going to go up more, or I think it's going to go down more based on some sort of speculation. That you want to stay away from that. That is death. That is what gets people to have worse returns than the market. Okay, people psychologically tend to do worse than the market when they trade on their own, okay, or invest on their own. Now, wonderful. Okay, fair enough. No big deal. The other thing that's really hard to know, aside from are we at the tops or are we at the bottom, is how long it's going to stay there. Okay, so when it comes down here, is this going to stay here for a week, a month, a year, 10 years? We don't know. Okay, the price of oil had gone down very low. Some people were speculating it would be a long time. Some people were speculating that it would be little time. It's tough to say. When will the price of oil go back up over $100 a barrel? Will it go over $100 a barrel? Tough to say. Okay. So that's not a game you want to play. It's too challenging. It's too uncertain. It's not based on a solid fundamental that we can rely on. The two things that we can rely on are value investing and growth investing. Now, growth investing, in theory, is better, although you can combine them together, but it's much harder to do, which is why we're going to focus on value investing, right? Which happens to be, if you look at the majority of people who beat the market, they do value investing. Okay. So here's the way that it works. If I want to beat the market, I'm looking for what's called a market inefficiency. Okay, something where the market is designed to be efficient, and what that means is that it should be a fair price for whatever it is. All right, so if something has a lot of risk, then it should be priced lower to account for that risk. And so in theory, everything, no matter what you invest in theory, it should all perform the same. That's kind of the general idea, right? Because the market has all this information and it knows in the aggregate, are things going to go up, are they going to go down, etc. Now, in fact, the market's not efficient, okay? But it is efficient over time. So over time, Warren Buffett says this. He says, in the short run, the market is a popularity engine, okay? So people are just, oh yeah, I like that, based on nothing but popularity. But in the long run, it's a weighing machine. And the weighing is the thing that we can rely on, okay? So this strategy, what we're going to talk about, you have to be willing to look out 3, 5, 10 years, whatever, okay? Now, growth investing would say, okay, I'm going to buy something that's going to grow over time faster than the market, okay? So I'm going to pick something that it performs better, okay? Great. Can you do that? Yeah, it's possible. If you were able to identify Apple in 2001 as a breakout success, you would have made a fortune. It way outperformed the market. If you looked at Netflix or Amazon or Google or a bunch of these at the right period of time, you got a way better return. Now, today, is Amazon or Netflix or Google a good buy? Is it going to outperform the market? It's really expensive, right? So what you need to know is that what you pay for and the price you pay for it are both very, very important, okay? Now, what you want to do is you want to pay less for something than it's worth, okay? We were just talking about those breakout successes. That's very tough. It's very hard to know. Like if you were looking at Netflix at a certain point in time, there's a lot of reasons to believe that it wouldn't grow a lot, okay? Now it did, grew 100% in a year or something like that. But how would you know that? If you can't have known it, then don't worry about it. What you want to pay attention to is what is it that we can know. Google, similar thing, Amazon, these companies, it's very tough, which is why Warren Buffett, if Warren Buffett's very, very good at this, and he doesn't invest in those, right? Keep that in mind. Okay, so you could, in theory, you could pick one that was going to do better, that's growth investing, but you're not going to try and do that, okay? That's not your goal. That is not what the game that we're playing here, because it's too complex. So in our other programs, if you're interested, we do go into details about how can you figure that out, all right? And it has a lot to do with compounding and how compound growth over time is going to work out. There's a lot of different factors into knowing what will compound and what won't, and what will spin off capital, and consequently how you can get these amazing growth rates, okay? But it's tough. It takes a lot of learning. If you want to kind of shortcut the process, join the action classes, and then you can look at what we're actually doing, and you can go through and we'll apply the rules, and you can take a look and get detailed analysis and do it with other members of the community and get suggestions from them, etc. That's, the ideal. For anyone who has, I'd say $200,000 or more, you will more than recoup your investment just through that learning in most cases. Like, if you have, the more money you have, the more that just becomes a no-brainer because of the investing knowledge and the expertise and how you're able to speed up your process. I mean, if you just get on $100,000, an extra 4%, you're profitable. It made you more money than the cost of the action classes by a bunch. If you have 200,000, it's way, way more. If you have 500,000, I mean, the cost is irrelevant. So keep that in mind. Anyway, here's the thing that you can do, though, okay? So you can't time, you don't know when it's going to hit the top, you don't know when it's going to hit the bottom, you don't know how long it's going to be down, how long it's going to be up. But isn't it true that when you're shopping, you have a good idea when something is low, and you have a good idea when something is high, right? So for example, talking about gas, when gas was at 56 cents a liter, do I know if it's going lower? No, I don't. Do I know how long it's going to stay that low? No. But I do know that's very low, okay? At this time period, 56 cents a liter was very low. Now it happened that within a few weeks, it was up to 77, and now it's 88 or whatever, but that could have lasted for a month. The point is, because I'm involved in the market, I can see when it's low, all right? Likewise, when I'm involved in, say, going shopping for groceries, I'm looking at chips, right? I see every week, okay, chips, a bag of chips sells for, I don't know, $3.50. Well, this week they're on sale, 4 for $10. I know that's a good deal. How do I know that's a good deal? How do I know that's cheap? Because I buy chips all the time. I look at them all the time. And so I know approximately what the fair price is for something, okay? Now, this is how you accelerate your return. Let's say that you know that something should be worth this much right here, okay? But it's actually priced down here, okay? If you're able to buy it down here, over time, the market will bring things to where they should be, okay? So just like in the grocery store, over time, those chips are going to go back to $3.50. You know this. This is the way that the market works, okay? It goes back to a fair market value. And we're a little more complex than that when we're talking investments, so again, bear with me. I'm just giving you a simplification here. You know that generally it's $3.50. You know that over the long period of time, it's going to go up slightly. It's probably going to get to 4 or 4.19 or whatever the number happens to be, whether it's a year or 2 years or 3 years down the road, right? And you know that it's gone lower than that. And so you know, hey, if I buy it when it's lower, it's going to go up higher, okay? That's a huge, huge deal. So Warren Buffett describes it this way. He describes, if you can buy $100 bills for $50, it's perfect, right? You buy for $150 and you have $100, you just made $50. Remember how I talked in, I think it was this first or second video, about buying a house? And how when you buy a house, you can buy for below market value, and the day you buy it, you can end up with extra equity you can add to your net worth? Yeah, that's what we're talking about. How does that work? Let's quickly explain this. There's pricing inefficiencies, okay? What does that mean? That means that sometimes somebody really needs to sell in a big hurry, so they price it lower than they should. Or somebody is selling and they don't know what it's worth, so they're selling it for less than it's worth. Or, I don't know, there's some sort of an estate sale or a divorce or something like that. Somebody's upset, so they sell for less than it's worth. There's some reason that they sell for less than what it's worth, okay? Now, are all of them like this? No. The majority of them are not. The majority of them are fairly priced. But if you're in the market, just like the majority of time, chips are going to be priced at whatever chips are priced at. Like I said, let's just say they're $3.50. But if you're watching all the time, then you're going to see when that sale comes on. You want to buy things on sale, okay? This is the thing that will put you ahead of the majority of people out there and put you ahead of the market, is if you can buy things for wholesale prices instead of retail. So most people pay the full price. Remember how I was talking about those fees? And how if you're buying, say, a mortgage investment corporation or a limited partnership for a development company or something like that, the 10% fees are there. Imagine if you buy and you don't have those fees, but everybody else does. You're ahead by 10% from day one. The exact same thing. You didn't buy anything differently. Maybe you signed up and you said, hey, look, here's what I'm going to do. I'm going to sign up as a salesperson for this company, and I'm going to take my own commission. So boom. Great, I just got my 10% commission and I bought the investment. Maybe that's probably not the way that you're going to do it, but the whole point is that it's a way of you're buying for less than it's worth. Another thing that sometimes happens is somebody is, as an example, pre-sales, right? They need to get those last sales in, or you're in a situation where, say like with rentals, right? You can say, okay, well, I'm going to buy it, I'm going to rent for longer term, so you're going to give me a discount. Or whatever. There's a bunch of different reasons, and those aren't necessarily those are great to do with making money, and we talk about them a lot in Richucation and definitely apply them in your life. But right now we're talking about investments. So for investing, say that house, right? If you're just looking in the market, you're going to find, oh look, there's some cases where, we can buy a house for less than it's worth. Perfect. Score. Awesome. We love it. What do you have to do? You have to be looking at properties regularly. You have to be ready to act fast, okay? You have to know what it's worth so that when you see it, you go and look. When I first bought my first house, I looked at 108 houses before I bought. I bought the 107th one. And, that was a lesson in getting to know the market. So after I'd seen 50, 70, 80 houses, I could walk into a house and tell you, this is like a fair price, okay? And there's ways that we can value things. And that's one of when you go into our different programs, that's one of the things we talk about, is we give you very specifically, okay, how do you use comparables? How do you use replacement costs? How do you use cash flow? How do you use these various different ways to analyze and get a really good idea of what something's actually worth and going to be worth in the future, which is the more important thing, so that you can price it based on today to find out if it's a good deal and if it's going to provide a superior return going forward. Make sense? So definitely go and sign up for those on the page, or sign up for the action classes. Even better, than you get all that for free, plus you get way more. Anyway, so this is what you're looking for doing. You're looking to find cases where you're buying something for less than it's worth. All right, imagine if you can buy something for 10% less than it's worth. All right, say a house, and you can definitely buy houses for 10% less than they're worth. 20% is pretty tough, but 10% you can do very frequently. Okay. Let's say the market goes up by 5%. So it was going to go up by 5% anyway. So anyone else who bought and they paid retail, they got a 5% appreciation. You got a 15% appreciation, right? It's actually better than 15% because your baseline was lower. But anyway, loosely speaking, say it was a 15% appreciation. So that's the way that you get superior returns, okay? You're looking for things that are priced at lower than they're worth, okay? And so how are we going to do that? Well, for stocks, remember how we talked about, so first thing you want to do is you want to look for solid assets, okay? So I'm going to write that up here for you. Solid assets. What does that mean? Well, the danger when you're investing, remember I said that investments are a little bit different than, say, buying gasoline or whatever. The danger is that that business that you thought, hey, it's a good deal. The reason it's a good deal is because it's on a downward trend, okay? And there's ways to figure that out, and again, that's in our very detailed analysis course, which you can go and take, or you can sign up for the action classes, get all that stuff for free, etc. But if it's on a downward trend, so it comes down to here and you say, oh, it's underpriced. It should be priced right here, but it's actually priced right here, so I'm going to buy it. Well, the danger is that, yeah, it is right here, but it's on a downward trend. The market knows something that you don't know, and so it's going to continue to get worse. Okay, so that's like a good example would be, Enron or something, right? Enron, when it dropped, you might say, oh, it's a steal. It's like, yeah, it's about to go bankrupt, So that's one of the reasons why. Remember, we talked about never buying something that isn't profitable. That's why. So solid assets, all right? You want to buy solid assets. Solid assets are something that they have long-term durability. And I'll give you a good example is the Canadian banks, okay? The Canadian, pretty much anything Warren Buffett buys, you can just literally go through his portfolio, and most of those are pretty solid because of the fact that he bought them, right? It's a great place to start. Solid assets, there's something that's not going to go away, okay? And again, there's a lot of analysis we can do, but that's where you're going to start. So just think about the big, solid brands that it's like, is it going anywhere? No, it's really not going anywhere. So Canadian banks are a good example. There's big 5 banks. What would have to happen for them to go down? Well, first of all, if there was anything serious, the government's going to bail them out because the consequences to the Canadian economy would be too great, all right? Number 2, are they going to lose customers, relative to somebody else? Very tough. Like, they're very established. Not a lot is going to change in that industry, right? Are they going to, they're the way that those banks are run, they're large, they're solid, they're in a highly regulated industry, they're very solid. Now, does that mean they're going to go up a lot? No, unfortunately, it means they're also fairly level. But it allows us to establish a nice baseline of where they should be. Okay. Other good examples are potentially large railroad companies, various different companies that they're very solid. You want something that doesn't have competition, or by that I mean not competition that's going to erode their market share, right? So everybody's kind of the same, right? That would be a good example. Frequently utility companies might fall into that category. Could be large brands like Coca-Cola, the famous Warren Buffett one, Procter & Gamble, companies like those. So, and we could also look at real estate. So again, cash flowing real estate, what do you want to look at? You want to look and say, okay, is it solid? Well, it's solid assets, so that's good. And then next is that economy solid? Okay, so is there likely to be long-term demand for that property? And if there is, great, okay? So that's the first thing, solid assets. The second thing is you want to look at better than market return, okay? And what do I mean by that? Better than market. What I mean by that is the profits, the cash flow, okay? So I'll give you an example. A piece of property, okay, might pay, depending on the market, 3% to 7 or 9%, okay? It's kind of the cash flow off it. Now, if you come across something that is 3%, is that better than the market? No, it's really not, right? If you come across something that is 9%, is that better than the market? Probably most of the market, yeah. If it's 12%, yeah, you're pretty solid, okay? A 12% return is better than the market return. And so what does that basically tell you? That basically tells you that, again, think about we're comparing ourselves to everybody else out there, okay? So everybody else out there is getting the average, okay? So the average is, let's call it 5%, okay? So if I can buy something that's paying 12%, assuming it's solid, right? Then we're all of a sudden beating the market, the average, by 7% instead of 5%, right? And the interesting thing is you might say, okay, well, but that's because maybe there's going to be less appreciation. In the big picture, money flows to returns, okay? That's money wants to create a return for itself. Money wants to grow. And as a result, generally speaking, something that's producing superior cash flow will, over the time, rise to be about balanced with the other assets. There's some nuances that that's not 100% accurate, but it gives you a basic idea, okay? So that's the second big piece. Now, the third big piece that I want to give you is just looking at and understanding these graphs, okay? What's the rule? Everybody has probably heard this before. You buy low, you sell high, right? Now, here's the thing. this is the key piece, okay? How do you know when it's low? Well, number one, it's based on this kind of average, right? It's based on this, there's this line here. This is like what it's generally worth. So think about the bag of chips, right? Bag of chips, generally $3.50. When it drops to $2.50, we're going to buy it. When it goes above $3.50, when it's $4, we're definitely going to sell it, okay? So this here, between what we're buying it for and what it's worth, that's where we get our profit. Okay, that's where we get our superior return. So when you buy this property that's performing better than the market, okay, you bought it for, let's say, 15% below market value. When it gets to market value, you're going to sell. And now, so meaning that, as an example, say your cap rate is the rate of cash flow, basically, from a property. When that goes from being 12%, the property becomes worth a lot more, and so it's down to 6%, where you're going to sell, and you're going to realize that gain. Now, this strategy requires buying and selling. Does it require a lot? No. Generally speaking, you can do 2 to 3 investments a year. So meaning I bought in here, I sold probably around here, I bought in here, I sold around here, I bought in here, I sold around here. Notice that I'm not trying to go up to the top, because I don't know where the top is, okay? What I'm trying to do is I know what the fair value is. And I know if I buy for less than the fair value by a large enough amount, then over time it's going to return there, and I'm going to capitalize on that difference. And I'm going to do that a few times. Like I said, 2 to 3 investments a year will generally put you ahead of the market. You may have to hold for 6 or 24 months, you don't know. But the point is that here's the other thing that's very interesting. Say you buy a property, say the property's worth $300,000, okay? And you buy the property for $250,000. Was that more or less risky than if you bought it for $300,000? It was less risky. Why? Because you're putting less on the line to start off with, so you can only lose $250,000. You wouldn't lose it all, but let's say that you could, right? Instead of $300,000. But more importantly, for you to lose money at $300,000, let's say we're right here, it has to, any drop from the fair market value, and you're losing. Versus if you bought it for less than it was worth, it needs to drop $50,000 just for you to be at the point where you're at, right? You haven't lost anything. That's so it adds safety. And this is one of the ways that we protect ourselves from the downside, is by buying things for less than they're worth. And simultaneously, we get more upside. So again, you just think about that. If I can buy the exact same thing for less, what will that do to my returns? It'll put them higher all the time, all day, every day, okay? If you can go and buy that, let's say a Ford Focus costs, I don't know, $10,000. If you can buy it for $8,000, what's your chance of making money off of it? Higher than if you bought it off for 10, right? What's your chance of losing money? Lower than if you bought it for 10. So we're simultaneously increasing our chance of gain and our significance of gain while decreasing our chance of loss and our significance of loss. All right? That is the key fundamental. That is the key point. That is the key distinction that allowed Ben Graham to lead the way in creating fantastic returns. That is the key point that will allow you to beat the market. What are you going to do that based on? You're going to do it based on finding solid assets. If you don't find solid assets, it's very difficult to do this, okay? And then finding that they perform better than the market, okay? So in general, an indicator to look at is what's called PE ratios, okay? So if you find a very solid company with a very low PE ratio, what does a PE ratio mean? Let's say the company is worth $10 billion, okay? So $10 billion, and its earnings, so its profits each year are $1 billion, okay? This is the price, okay, 10 billion. This is the earnings, so price to earnings ratio, so that would be a price to earnings ratio of 10, okay? Now, what that means is, in theory, the profits from it should pay back that initial investment amount in 10 years. If this was 2 billion instead, then you would be talking about 10 divided by 2 is 5, a PE of 5. which means it would take 5 years to bring it back. So you don't want to buy anything that has a PE ratio over 20. Just don't even bother. If you want to beat, like, if we're talking about beating the market, generally you're looking at PE ratios that are like 10, less. It varies by industry, and again, that's something that we analyze in a lot of detail for you to help understand these things. I only have so much time with you, unfortunately, here. But this is the thing to pay attention to, is how much money is it making relative to what you're paying for it. And if you can make more money compared to paying less, you're better off, right? That makes sense, right? You just understand, hey, listen, I want to get $10 a month. Great. If I have to pay $100 to get $10 a month, that's not as good as if I pay $50 to get $10 a month, right? If I have to pay $10 to get $10 a month, that's even better. That's what we're looking at. That's the concept here. And that's not necessarily always going to hold true if it's not solid. That's why you want to pay attention to solid first. It's very solid, and then this. And then, generally speaking, you're going to see more pronounced swings in your favor, so it'll be less down and more up, relatively speaking. And you're going to get in there. Now, the last thing that I'm going to leave you with is what Ben Graham says. He said if you were forced to sum up all investing wisdom, it could be summed up with 3 words, which is margin of safety. Okay? What this means is whatever you think it's worth, you might be wrong. So you want to put a margin of safety in. That means, let's say that I buy a property and I think the property is worth $330,000, but I might be mistaken. Okay? So what I actually want to do is I want to say, well, it's really worth, I'm going to say it's worth 300. And so anything under 300 is what I'm looking at buying it for. I don't get to count that initial part because I might be mistaken, right? My evaluation might be inaccurate. So if you think a stock is worth $100 a share, you might be mistaken. If you think the PE ratio, a fair PE ratio for it is 11, you might be mistaken, so count it at 10. Everything below 10 counts, everything above it doesn't. And what you want to do is, you say, okay, I think it's 11, it's at 9, great. I have ratios, I'm going to buy it. Now when it goes up to 11, I'm going to sell it, because there's no more upside potential that's going to beat the market. Does that make sense? That's a high-level overview of how to get better than market returns. It is the way that, like I said, if you look at almost all of the people who consistently outperform the market over a long period of time, they are almost all value investors. This is almost always their philosophy. There's some growth investors and a lot of people who combine the two together, but growth investing is a whole other ball of wax. If you want to get really deep into this stuff and you want to learn to get not 2% better, but 4% or 6% or 8% better, then join the action classes or sign up for, we have very inexpensive, like very comprehensive training that will go through all kinds of different indicators, way, way deeper than this, because there's a lot of other factors to pay attention to. Historical values, like I said, comparables, paying attention to where price to earnings ratio, PE ratios can throw you off, and so looking at cash flow or leverage-free cash flow and things like this, paying attention to what Warren Buffett calls owner's earnings, and lots of these different other numbers that are going to help you to understand book value and net current asset value, all these complex things. You can pay attention to them and see how you can get a far superior rate of return. It takes some work, and so that's where the action classes come in. You can say, hey, I'm looking at this company, what do you guys think? And we can go through and break it down with you and say, okay, well, let's use the model, let's analyze it. Okay, is it selling for below the comparables? Is it, all this kind of stuff. And yeah, it's really, really, really powerful. Very, very strong stuff. I hope that's great for you. Tomorrow, we're going to go over taxes. Remember I said, if your tax rate's 50%, if you just reduce that rate down, or don't pay tax ideally, but let's say you can reduce it to 20%, you're way ahead of the person who paid 50 or 40 or whatever the percentage is. So we're going to show you how to do that, what you specifically need to be doing in terms of your planning, at what stages, etc. And that's going to be a wrap. We're excited to spend some time with you. Reach out to us, check things out. We're here to assist you. Let's make this happen. We'll see you tomorrow.